Well, hey there, it's Terry Sawchuk. It's Thursday, so that means it's time for 3-Minute Thursdays. Wanted to do a brief market update today. The reason is there's been some, I think some meaningful change in the tenor of the market over the last few days. So there's a couple things that I want to draw attention to. It looks like we got, what appears to be potentially a short-term bottom here in the S&P 500. Last week, we thought the potential for a bigger downturn was there just based on the release of all the economic data after Jerome Powell's miraculous, dovish sort of take on things. That opened the door for markets to push a bit higher. Today's unemployment numbers came out a little hotter, meaning that it looks like the employment market might be starting to slow down a little bit. And, it's not, when you look at this, it has nothing to do actually with unemployment. It's more to do with the reaction function of the Fed as it relates to unemployment. And there were some concerns about, the Fed potentially having to raise interest rates because inflation was running hot, employment numbers were hot, et cetera. So a little cooling off in the data takes some of the paranoia away from the markets in terms of the Fed actually increasing rates. But the truth of the matter is, they're not going to cut rates anytime soon. And the odds of the Fed actually cutting rates in 2024 are going down by the day because inflation does persist. And even though the unemployment numbers might have ticked up a little bit, the reality is the unemployment rate is still really low, and it's going to be very, very hard to justify rate cuts unless you get one of two things: either a significant, meaningful rise in unemployment or a significant drop in asset prices. Now, either one of them is possible, but the more likely scenario probably is that the Fed would step in if we got a big sell-off in the equity markets. The problem with that theory is that there doesn't seem to be an imminent catalyst. The corporate earnings have been solid. Inflation is running higher than what I think the Fed would like to see, but there's nothing that's like an imminent catalyst that's just going to automatically drive prices down, short of some really hot economic data or some kind of significant elevation in tensions in the Middle East or in Ukraine or wherever. If we don't get those things, then the backdrop is actually reasonably positive. And while I don't think we're going to get a big move in either direction, probably the underlying tone is to just push a little bit higher. Again, we could see a little volatility, and we haven't gotten back to the high yet at 5260 on the S&P. That's still out there. The Japanese yen has calmed down a little bit, but that could rear its head and that could be an issue. So there's a few things that we're watching out there, but I would say in the very, very short term, it appears that the coast is clear, and so we're going to kind of maintain equity positions. We're not really going to increase equity exposure, but we're certainly not taking risk off the table at this point, and we are watching the data very closely. So that's going to wrap up this week's edition of 3-Minute Thursday. I look forward to seeing you guys next week.